The Reserve Bank today reduced the official cash rate by 25 basis points to 1.75%. We considered the decision this morning in light of the US election results and reaffirmed that we believe it was the right decision. Significant surplus capacity exists across the global economy despite improved economic indicators in some countries. Global inflation remains weak, even though commodity prices have come off their lows. Political uncertainty remains heightened and market volatility is elevated. The exchange rate remains higher than is sustainable for balanced economic growth. Together with low inflation, it continues to generate negative inflation in the tradable sector. A decline in the exchange rate is needed. Domestic growth is being supported by strong population growth, construction activity, tourism, and accommodative monetary policy. Recent dairy auctions have been positive, but uncertainty remains around future outcomes. House price inflation remains excessive and is posing concerns for financial stability. Although house price inflation has moderated in Auckland, it is uncertain whether this will be sustained. Headline inflation continues to be held below the target range by ongoing negative tradables inflation. Annual inflation is expected to be within the target range from the December quarter, reflecting the policy stimulus to date, the strength of the domestic economy, and reduced drag from tradables inflation. Monetary policy will continue to be accommodative. Our current projections and assumptions indicate that policy settings, including today's easing, will see growth strong enough to have inflation settle near the middle of the target range. Numerous uncertainties remain, particularly in respect of the international outlook, and policy may need to adjust accordingly. So there's uncertainty about a lot of things. There's uncertainty about Brexit and Article 50. Theresa May has indicated that the UK will trigger Article 50 by March. There's a lot of issues around what that process might look like and what the negotiating stance would be. There's quite a lot of uncertainties around China. We've just seen the recent plenum where you saw the centralisation of the power of the president. There's lots of issues around debt accumulation in China, particularly corporate debt. And we've seen a result overnight that has clearly surprised the markets.
Governor, do you expect today's cut to be reflected at all in term deposit and mortgage rates? Because some of the banks have suggested that even if rates were cut today, that it may not be reflected.
Well, that's very much up to the banks. If you look at the banks' funding situation at present, you know, they've got lending growth rates exceeding their deposit growth, and so they're having to move to offshore wholesale markets to get some of their funding, and that's more expensive funding for them. So you're starting to see some upward pressure on deposit rates, and you're also starting to see some increase in mortgage rates. So it's possible that we may not see a lot of adjustment in terms of lending rates. Possibly there may be some on floating rates. They may adjust a bit. But in essence, you know, this move has really been built into the rate structure. I mean, we've signalled that there's a high probability that we would be cutting rates. And if you look, say, for example, at one-year fixed rates since late 2014, they're down about 170 basis points. If you look at two-year fixed rates, they're down about 200 basis points. So in many respects, this is really a validation of what the market has been expecting.